Rob's Child, no investment advice. Welcome back to the series where we go over every chapter of Ben Graham's The Intelligent Investor, revised edition from 1972. Again, the purpose of this series is not to replace any content of this book, but to open it up for discussion, to bring it up to date, to see what's happened since this book has been written, what's going on now, how it relates to investing today, and also how it relates to his tome version of Security Analysis, second edition from 1942. Today's episode is Chapter 17, 4 Extremely Instructive Case Histories, where we go over 4 stocks that had some very interesting things going on. I'm going to say right off the bat, these 4 extremely instructive case histories would pale in comparison to what we've seen since 1972 in securities markets. But we'll get to those points momentarily. The introduction of the chapter introduces the 4 cases and then breaks them down into the 4 parts of the chapter. The first example we bring up is Penn Central, a railroad, the biggest railroad company in the U.S. At its time, it had extreme overvaluation and very deceptive earnings. As an overview, it shocked the financial world when the largest railroad company went bankrupt in 1970. That would be like NVIDIA going bankrupt, just to understand how that would have felt in 1970 for the railroads. And it just goes to show you how confident markets can be in an entire industry and yet have the largest, biggest company in that industry fail. Unbelievable. The stock went from a high price of $86.50 to $5.50. Now, one of the clues that he says was leading up to this was such a solid company in 1967, it had its interest covered by only about 2 times when he references his own security analysis, this book that I bring up all the time. This is it. This is the book he's talking about, security analysis. And he says, from our book, he says, for railroad bonds, our minimum is you got to earn 5 times the interest coverage before income taxes and 2.9 times after income taxes at regular rates. And while this company in 1967 was only covering it by 2 times. So in other words, in 1967, he's saying, guys, I spelled it all out for you in the 1940s for this giant company, and then they go bankrupt. I think he was proud of himself referencing his ability to see this coming, see the amount of risk, the increased risk here. I'll add in right now that to have a company that can cover its interest charges by 5 times in any industry today, I think is non-existent. The amount of leverage and the amount of fragility we have in today's securities markets would be very, very shocking to Graham. He to the point where I think he might be living in a cave. I don't even know. It would scare him a lot to see what's going on in today's markets in 2024. So some other clues that this company was not going to do well was that it wasn't actually even paying its income taxes for 11 years. And so the earnings weren't valid. This 2 times earnings wasn't even counting, apparently. It sounds like back taxes that they had owed that they weren't paying, which is really, really bad. And then he says there were much better covered bonds in the market at that time with a similar coupon rate. So if you have a company that's, earning plenty of money to cover the interest on its bonds, and this company is barely cutting it for the same coupon, you obviously would be safer with other bonds here. And obviously, making the case of the stock price to be even more frightening as far as safety goes. And then we say that the earnings were also skewed by merger costs and formation of itself, Penn Central. And then somehow had much higher profits than its peers. So on paper, it's just a railroad company, and somehow its profit margins were somehow able to be so much higher than everybody else. And that doesn't really make sense, because if people choose between, like, okay, am I going to pay a ticket to go on this railroad or that railroad? It's a competitive industry, so you should expect a pretty competitive difference of, yeah, pretty similar profit margin or whatever. And so for it to somehow magically have a lot higher profit margin should have been a sign that maybe there's something funny going on here. And then we end this first section of the chapter with his moral, the moral you're supposed to learn, which is that security analysts should do their elementary jobs before they study market movements, gaze into crystal balls, make elaborate mathematical calculations, or go on all expense paid field trips. This is basically just emphasizing the point that, these were things that were very, very clear and easy to see, and the market missed it, apparently, and it turned into a disaster. The second extreme example from this chapter is Ling Temco Vought Incorporated. Overall, it was really an extreme speculation, including indiscriminate bank lending, as he calls it. So this started as a one-man show, basically selling lots of stock, being his own investment banker. And he shows a table of some of the financials. Here's the table right here. It's in the book. Also, I didn't mention at the beginning of the video, the entire book in a PDF link to the whole book is below. Just click on it. The point of these series is for you to read it and then kind of review it with me. And also add comments. Please add comments in the section below if you feel there's anything worth adding or discussing further. But this is the table here, 1958 through 1970, showing how sales went from $6.9 million all the way up to almost $4 billion, and then back down to only $374 million in 1970. Times earned of its interest charges, we, covered our interest charges 5 times over in 1958, and then down to 4.8, and then all the way up to 54 times earnings, and then back down to 1 times earnings, and then below 1 times earnings at 0.68. I wanted to add a note here. It's pretty obvious. If you're watching this video, reading this book, you're probably pretty aware that, today's markets see stuff like this every day, that this is not... this was like, these are extreme cases that he's bringing up that he's hoping is just going to teach the world. Things have gotten worse since then. Again, Graham would not be, he would be flipping out to see what's going on today. But I digress. Moving on, they consolidated all possible charges and reserves into one bad year. He writes how the stock was trading at 22 times its asset value. So that's like a book value of 22, which is very high, again, compared to today's standard. You see this everywhere. This is nothing. It pales in comparison to what we see today on a regular basis, which should make people even that much more scared of what's going on in the financial world, in my strong opinion. But especially, specifically today, by the way, as of this video is coming out, we're at the end of November 2024 with the S&P 500 trading itself at a PE ratio of 31. This is while bond yields are still over 4%. It's I think things, in my opinion, are gonna get really rough from this date. But anyway, moving on, a year later, $77 a stock, but only $3 of actual assets, discluding a huge bond discount asset, the value of its preferred shares and its goodwill. And this, it was accounting its, it apparently bought bonds at a huge discount, and then counted the difference between the price they bought it at and the par value as like an asset somehow. Ridiculous accounting going on there. And then moving on, price peaked at $169.50. And then 3 years later dropped down to $7.13. And again, my note, since then this happened, this seems to happen all the time. I mean, just look at how ARK, Innovation, ETF, all those stocks just ballooned so enormously high and went so far down since then. And then we have the moral of the story section. He's amazed at how commercial bankers were persuaded to lend so much money to them. And he believes that hopefully Wall Street learned its lesson. And my comment is it couldn't be further from the truth, unfortunately. Moving on to our third example of NVF Corporation, basically involved in a takeover of Sharon Steel. It was sort of a backwards acquisition. So the company they were trying to acquire was 7 times the size of itself. Typically, when you have an acquisition, it's a big company trying to eat up a little company to, make it better, put it under better management, give it a more solid, financial backing or whatever. And this was the opposite. We have a little company that did this, hostile takeover of this big company using debt, using lots of debt, basically. So anyway, the original company, NVF Corp, was a company that vulcanized fiber and plastics. Trying to buy Sharon Steel 7 times the size of itself. Essentially abused financial tactics, adding leverage, and then running the company into the ground. One view I have of this that isn't mentioned is that, like, if the company was run really well, maybe it could have been okay. But, the adding of leverage onto it is just, it's like what's going on in corporate America today, everywhere. And if you don't get like the most amount of leverage possible, then, you can't compete with other people that are doing that. And, in today's Wall Street situation, it's so scary out there. Anyway, I keep reverting to that same point, but I think it's important. In addition to increasing the debt, they were selling all these warrants, and the warrants well exceeded the total market value of the outstanding NVF stock. So again, if you remember from our chapter on warrants, how he hates how companies basically abuse selling these warrants, making them seem like such a cheap, like, easy way for investors to like gain an enormous amount of wealth potentially. And it feels that way as an investor when you're looking at warrants, an agreement to, long-term basically options contract. But the way it ends up playing out is not to the investor's favor, as we reviewed. I think that was in the last chapter. But anyway, the company also did some very odd and ingenious magic to save on taxes. That's in the appendix. We're not going to go over that specifically, exactly how they did it. And then while in highly stressed debt in 1969, the company bought an enormous amount of warrants, and then it had plans to sell its employees not just stock, but also even more warrants that were bought with 5% down and to be paid off over time. So they're selling these leveraged products to the people that work for them for only 5% down. You pay it off over time. Like, it's like a lottery ticket that you make payments on. Like, absolute insanity going on here. But anyway, moving on, 1970 listed as having the lowest PE ratio in the entire book of only 2, but it wasn't accounting for dilution, and also, like he mentions in the chapter, quarter 4 of 1970, which was after, I think, the edition where it was listed at a PE ratio of 2. And then, so it had over-leveraged debt. We had $135 million of debt versus the $14 million of equity. Again, this is like normal today. Take out the goodwill of so many ginormous companies today, and the real book value, scary times we're living in my opinion, in 2024. See how it all plays out. The more I learn about finance and Graham's perspective on all of this, the more scary it seems to me that we really might be in another 1929 kind of scenario today, specifically the end of November 2024. But anyway, back to the chapter. The last company, the fourth one, is AAA Enterprises, and the magic word being franchising, with nothing to back it essentially, and the stock was selling at a high price without anything really to back it up. The company started basically as a college kid selling mobile homes. He used the word franchising. He let others sell mobile homes under his brand name, and then kept adding to the company. He created a company called Mr. Tax of America to do income taxes out of mobile home offices and franchised it. AAA, really genius name of a company. Back in the day, they had phone books, or to find the phone number to contact, without any internet, to contact the company, you call them, and the yellow pages would start with AAA. Not only that, the S&P 500 guide itself, suggests having like a whole bunch of choices of investments. AAA, first one in the book. So pretty interesting. And then, so anyway, the stock got overly expensive to book value and sales, etc. It expanded even further, opening carpet stores and mobile home manufacturing. So not just the sale of them, but actually manufacturing them. When they went public, they were sold at a price of $13, went quickly up to $28, and then eventually down to $8.50, and then continued down to 50 cents and bankruptcy. So the moral of the story of this last one is that, and I quote here, and I really like this quote, so I'm going to read the whole thing. The speculative public is incorrigible, which means not able to be corrected, improved, or reformed. It will buy anything at any price if there seems to be some action in progress. It will fall for any company identified with franchising, computers, electronics, science, technology, or what have you, when the particular fashion is raging. Our readers, sensible investors all, are of course above such foolishness. That's right. When valuations don't seem to matter at all, if you're a fan of his work, if you're a fan of my work, my channel, you'll know I don't support chasing the momentum, running with the herd of sheep into insane valuations that don't make any sense, and that's what this is really all about. And then we talk about since 1914. He says, ethical, and I quote here, ethical standards of the street, Wall Street, have fallen rather than advanced in the ensuing 57 years, despite all the reforms and all the controls. And so, again, his hope is that things will get better, and if you're watching this video past 2024, you know that things have really only gone worse. The dot-com bubble, the great financial crisis, and the AI bubble, which we're currently in, by the way, and the semiconductor bubble, I'll call it. My take on it, people are dumb, greedy, self-destructive when it comes to investing. Always have been, and always will be, apparently. And that's all I have from Chapter 17, 4 extremely instructive case histories from Ben Graham's The Intelligent Investor. Hope you enjoyed. Thank you for watching, and see you next time. Rob's Child.